Here's a number that should bother you. The national average savings account in May of 2026 pays exactly 0.45%. That's 45 basis points. The official inflation rate, as measured by the Consumer Price Index, is 3.8%. Do the subtraction and your cash in the bank is losing more than 3% of its purchasing power every single year. $100,000 in a regular savings account 5 years from now is worth about $86,800 in today's money. You did everything right. You saved. You kept it safe. You followed the rules your parents taught you about putting money in the bank. And you lost more than $13,000 of purchasing power just by doing nothing. That is not bad luck. It is not a glitch in the system. Economists have a name for it. They call it financial repression, and right now, in the spring of 2026, it is the single most important financial concept most people have never heard of. Let me show you what it is, exactly how it works, what the data says about where we are today, and most importantly, what you can actually do to protect the money you've worked for. Financial repression is the deliberate policy of keeping interest rates below the rate of inflation. When the government borrows at 3%, but inflation is running at 4 or 5%, the real interest rate is negative. The borrower, in this case the government, pays back its debt in dollars that are worth less than the ones it borrowed. The lender, that's you, the saver, the pension fund, the bondholder, absorbs the difference in lost purchasing power. It is, in every real sense, a tax. It never appears on any bill or any tax return. You will never see a line item called Financial Repression Surcharge on your bank statement, but it takes money out of your pocket all the same. Why would any government do this on purpose? The answer is a single number, and that number is 38 trillion. That is the current size of the United States national debt. The annual interest payment on that debt has now crossed $1.1 trillion. To put that in perspective, it is one of the single largest federal budget line items, consuming roughly 20% of all federal revenue. If the Federal Reserve raised interest rates to fully fight inflation, if they pushed the federal funds rate high enough to really bring CPI back down to 2%, the cost of servicing that debt would explode. Higher rates mean higher interest payments on the entire 38 trillion. Higher interest payments mean more borrowing to cover the gap. More borrowing means a bigger debt. It is a trap. The government cannot raise rates enough to stop inflation without bankrupting itself. So instead, it does the opposite. It lets inflation run a little higher than rates. It regulates banks and pension funds into holding government bonds, creating a guaranteed buyer for its debt regardless of the real return. It allows the purchasing power of your savings to slowly drain away year after year, so that the real value of the national debt drains away alongside it. This is not a theory. This is not a fringe idea. The United States did this exact thing from 1946 to 1974. After World War II, the national debt stood at 116% of GDP, roughly where we are today, at about 120%. The Federal Reserve imposed explicit yield curve controls. They capped interest rates. They kept them artificially low. Inflation during that period averaged between 3 and 5%, while savings rates stayed well below that. And over 28 years, the real debt-to-GDP ratio fell from 116% to roughly 32%. Not because the government paid down the debt, not through austerity or budget surpluses, but because inflation quietly reduced what every dollar of that debt was worth. The economist Russell Napier calls it the quietest form of default ever invented. Now here's where 2026 is different, and the difference matters. In the post-war period, the US economy was growing explosively. The private sector was rebuilding, veterans were forming households, productivity was surging. The debt ratio collapsed because the denominator, GDP, grew very fast. Today, the US runs structural peacetime deficits of 6 to 8% of GDP with no political appetite for spending restraint. There is no post-war boom coming to rescue the math. What made financial repression work the last time, a fiscal exit ramp and a demographic explosion, does not exist today. So what does financial repression look like in your actual portfolio? It takes 3 forms: The first is the saver's tax that I opened with. Cash earns between 0 and 3%, while inflation runs at nearly 4%. Every dollar you keep in a regular account is a dollar being harvested by inflation. The second is the bond trap. Government bonds are supposed to be the safest asset in the world. But when a 10-year Treasury yields around 4.3% and CPI is at 3.8%, your real return is roughly 0.5%. When you account for your personal inflation rate, the things you actually buy, like rent, healthcare, and food, that real return vanishes entirely. Many institutional investors have started calling longer-term government bonds certificates of confiscation. They are stable in nominal terms. They are losing money in real terms. The third effect is the most dangerous one. Financial repression forces capital to move up the risk curve. If your safe assets are quietly losing money, you have to reach for yield somewhere else. You buy stocks at record valuations. You buy real estate at elevated prices. You buy into asset classes you do not fully understand because the alternative, holding cash or bonds, guarantees a real loss. This is how bubbles form. The data says it is happening right now. The Philadelphia Semiconductor Index is trading 62% above its 200-day moving average, the widest gap in its history. The S&P is at all-time highs, while the bond market is screaming that something is wrong. They cannot both be right. The yield on 30-year Treasury bonds hit above 5% for the first time since 2007, and that happened while the Fed was cutting rates, the exact opposite of what is supposed to happen. That is the bond market voting with real money. It does not trust the Fed's ability to control inflation. The good news is that understanding the problem is the first step to solving it. And the solution is not complicated. You need to stop measuring your financial health in dollars and start measuring it in purchasing power. The first defense is what I call the real asset anchor. Before you do anything else, make sure you own assets whose prices naturally rise with inflation. Stocks are the classic example. Companies raise prices. They pass costs to customers. Their nominal earnings grow with the currency debasement. Real estate, commodities, are REITs, productive assets that earn a real return through inflation, not despite it. The exact mix depends on your situation, but the principle is the same. If inflation goes up, your portfolio needs to go up with it. The second defense is a TIPS ladder. Treasury inflation-protected securities are the only asset the U.S. government issues that contractually guarantees you a real return above inflation. As of May 2026, 5-year TIPS are yielding about 1.4% real. 10-year TIPS are yielding around 2% real. That means if inflation runs at 3% over 5 years, your TIPS will pay you roughly 4.4%. 2.5 points of that is the inflation adjustment, the rest is your real yield. A $500,000 TIPS ladder built today would generate about $92,000 over 5 years. All of it Treasury guaranteed, every dollar adjusted for inflation. This is not a get-rich tool, it is a floor. It guarantees that at least some portion of your savings is contractually protected from erosion. The third defense is what I mentioned earlier, but with a specific mechanism. Dividend compounding through companies with real pricing power. Dividend growth ETFs like SCHD and VYM own companies that have a demonstrated ability to increase their dividends over time, which means they pass inflation to their customers and grow shareholder payouts above the inflation rate year after year. SCHD's trailing 5-year dividend compound annual growth rate is roughly 11.6%. That is not a stock tip. It is a structural property of businesses that sell things people need and can charge more when costs go up. When you reinvest those growing dividends, the compounding works in your favor even while inflation is working against cash. There is a reason Warren Buffett has always favored businesses with pricing power. Coca-Cola can raise its prices when inflation rises. A utility company can pass through higher energy costs. A bank can charge more for loans. These businesses do not just survive inflation, they thrive in it and their shareholders benefit. Here is the practical takeaway, and it is the most important thing in this entire episode. The most dangerous financial mistake you can make in 2026 is keeping more than 3 to 6 months of essential expenses in cash or near-cash instruments. Everything beyond that emergency buffer needs to be working for you in real terms. If your checking account has a balance that covers a year of expenses, inflation is silently taxing the excess. If your 401k bond allocation is yielding less than inflation, those bonds are losing money in real terms. If you are sitting in a money market fund earning 3.5% while inflation runs at 3.8%, you are treading water at best. I want to be very clear about what I am not saying. I am not saying the dollar is collapsing. I am not saying we are heading to hyperinflation. The data does not support either of those. What the data does support is a slow, persistent erosion of purchasing power, engineered by policy, backed by precedent, and sustained by necessity. The federal government has 38 trillion reasons to keep real rates negative. And the evidence from 1946 to 1974 shows they are willing to do it for decades. Russell Napier, the macro strategist who has studied financial repression more carefully than almost anyone, summarizes it this way. There are only 5 ways a country can reduce an unsustainably large debt burden. Austerity, which is politically impossible. Default, which is destabilizing. Hyperinflation, which is socially explosive. Very high real growth, which is improbable at current demographics. And financial repression. When you line them up, the choice writes itself. Repression is the only option that works quietly, gradually, and without anyone having to announce it. That is not an accident. That is not a conspiracy. It is the arithmetic of a government that has more debt than it can afford at honest interest rates. And the question for every saver, every investor, every person who has worked to accumulate anything is simple. Are your savings actually saving you? Or are they quietly funding the government's debt reduction year after year in dollars that buy less every time you cash out? Here is the hard reality. The system does not need your permission. It does not need your agreement. It is operating exactly as designed. The only question is whether your portfolio is built for that reality. Inflation is not a bug in the system. It is a feature that balances the government's books. The defense is not to fight it. You cannot outrun the printing press. The defense is to own things that rise with it. Real assets, inflation-protected bonds, and productive companies with pricing power. And the moment to start is now, because the erosion has already begun. That is financial literacy, not luck.